I have one question on style investing, that is growth versus value. So, I personally believe it is very cyclical in nature. For an example, between calendar year 17 to 19, growth outperformed value by around 20-25%. Between 20 to 22, value outperformed growth by around 10-15%. So, first of all, how to determine what are the parameters of when which style to adopt, and what are the parameters which helps you to decide when the cycles are changing. That will help us to, to make a better influence decision.
I'm going to give this question to Mihir because his classroom lecture today actually is, relating to this subject. Mihir, you were going to tell us about this beast called valuation, how to look at it, how to befriend it. At times we want to forget about it when the market is running away. So I think it's a question that a lot of us grapple with. And as our friend here is asking, this has been the year of power stocks and capital goods stocks. I mean, these stocks never worked for decades. Absolutely. And now here we are.
Absolutely. So it's a very pertinent question at all points in time in the market, not only today. So I mean philosophically, when you're talking about investing in stocks especially, it's a function of various parameters, and stocks and companies are impacted by so many variables. So as an investor, the only thing that is in our control is the price at which you enter or exit the stock, and that's where valuation comes into the picture, right? Because if you think the actual value of the stock should be much higher than what the current market price is, then you buy, and vice versa. If you think the actual value is should be below the current market price, you are a seller in the stock. So valuation, when you go about valuing a company, basically at the crux of it, you're trying to say this is the current book value of the company, and the company is likely to generate cash flows in the future. So let me calculate the value of those future cash flows. Typically, near-term cash flows are more predictable, more visible, and the far out cash flows are less predictable, less visible. So what we call the first 10 years, typically 5 to 10 years, is the visible or the forecast period, and beyond that is what we give a terminal value. Now, the terminal value also assumes a certain growth rate beyond the 10 years. What happens is that in high growth companies, if you look at the overall value of the when you calculate the overall valuation of the company, the value of the terminal value is dominant, and the value of the near-term cash flows is less dominant, and vice versa. In slower growth companies, typically the value of the near-term cash flows is higher. So what growth investors tend to do is they don't mind taking a far-out view. They would ascribe some significant value because they do expect the growth to continue for a longer period of time. So when you look at the value investor, they tend to give more importance to the visible, the tangible net worth, the tangible book value, and the near-term cash flows. That's where the difference in philosophy happens. In bull markets, people tend to be more optimistic. They want to see far out in the future, so maybe the growth investing style works better. In choppy markets, typically people are risk averse. They say, no, let me focus on the near term. I don't know what's going to happen in the future. So that's when typically the value style comes in the focus. So it's to some extent a function of the sentiment and the business cycle that we are in. So that's where the difference between growth and value comes in.
And personally, would you call yourself a growth stock picker or a value stock picker?
I'm personally a growth stock picker.
Okay.
Because we are in India, we are a growth market, and one of the things that you keep reading is that Indian market valuations are at a premium to global, so we are expensive. But the fact is that I looked at the data since 2006. India has traded at a premium to all other markets, including emerging markets and developed markets. And that's because India has always given higher growth in terms of GDP, in terms of corporate earnings. So valuation takes into account long-term growth, and India has delivered long-term growth which is superior to others, and so we've always traded at a premium. So that's where the heart of a country, when it's growth, I'm a growth investor for India.